Now, we are within reach. That's how we're phrasing it. Dow 20,000 in this market alert to start you off on Cavuto Coast to Coast, up by 21 points. Remember last week we got at one point within 13 points of the magical Dow 20K, if it is that. So 19,955 right now. There is some sort of a building sentiment on Wall Street and elsewhere that we'd like to get this milestone out of the way. There is the Dow over a little bit of a longer period of time. This last week we've been watching it. It seems like on a tick-by-tick basis just to see if we can pass this round number. What we've done at the top of the show today is we've lined up three very smart people to talk about it, what it means, what it doesn't mean, and where we're going from here. There they are. Michael Block, Jonas Ferris, and of course Nicole Petallides down at the New York Stock Exchange with us. Why don't you start us off, Nicole? I know we talk all the time about resistance in markets. Usually the reference is to the S&P 500, I think, but there does seem to be some resistance around this big Dow 20K round number, right?
It's true. And while it seems so easy to get through a number, you don't actually have that. You have to sort of test the top, and then break through. And you need a catalyst to really push you through that number. And with a lack of trading volume, we're about 50% under a monthly trading average. And the headlines are not really giving the boost. I mean, we have consumer confidence, 15-year high. We're up 21 points.
Right.
Home prices soaring. So we're not really getting that. The one trend that I will say is evident, and that is optimism, hope. This is all on Trump's policies and also some better earnings. So the idea here is that the consensus is that 20,000 is coming in the near term, but not so easy to actually attain it.
Yeah, exactly. We've been hovering around it for quite some time. All right, so Michael and Jonas, let me ask you it this way. I mean, we've spent so much time having conversations about what if, what's going to happen afterwards. It's almost like we're looking for something new to talk about. Jonas, as you work your way into the end of the year, that's kind of what we do at this time of year. We take stock of where we've been, what's up next year. What's kind of item number one on the Jonas radar screen right now? What are you thinking the most about?
Does the psychological backbone, which has been really driving the market lately, and that's why the Dow 20,000 thing is relevant, because it is kind of a positive feeling that retail individual investors, not institutions, get, because they think that we are moving from low rates to low taxes, and that's going to drive the next bull market. It's been since 1999 since we broke through a major threshold like this. Does that continue to drive the market to just higher and higher valuations for next year? Or ultimately, do these policy changes, whether it's tax cuts, corporate tax cuts, do they actually benefit earnings so they both can grow? We can have a real kind of bull market that isn't just on hope of future earnings growth. That's really what I want. Does it transition into a real fundamental rally next year, or does it just poof out as just over-enthusiasm by individuals? All
right, so let's talk about that for a few minutes then. Michael, one of the things Nicole mentioned was the fact that consumer confidence hit this high today, and we haven't seen it at this level since 2001. So people are becoming more optimistic, even when it comes to their expectations about stock prices. We haven't had people this optimistic about stock prices since 2004. So should we start to worry or start to have conversations that people are becoming overly optimistic? How do you look at it, Michael?
Yeah, I think we're pricing in quite a bit here. I get it. Deregulation's good. Pro-business president and Congress are good. But let's ask ourselves, consumer confidence making these highs here, is that a topping signal? I don't see wages going high enough to justify that everyone has more disposable income to buy. Maybe there's a wealth effect here going on with the stock market. By the way, this Dow 20,000 thing, I've been watching Sandra, Ashley, now you all morning. Have you guys ever heard the term, a watch pot never boils?
I know, it is our fault. Trust me, I feel, you feel almost dirty, don't you, after a while talking about it? You say, come on, we're killing it here. It is, if people want to blame the media, we have to take the blame on this one. So at some point, we'll just start to ignore it. We'll turn our back for a second. It'll shoot up 50 points. Down 20,000. There it is. It does. I'll come back to you, Nicole, in a second. But Jonas, see, Michael's talking now about the question you're asking, right, which is about where are we going into next year? At some point, there has to be delivery on these promises that are made. Of course, you're not going to say that point has to be before a new president is even inaugurated. But if there isn't, are we setting ourselves up, I wonder, in the market for some sort of a, at least correction, right?
Well, stocks are expensive, but they're not 1999 expensive. So actually, there is room for, if you want to just have pure valuation expansion, you have a long way to go to the all-time highs, basically, of early 2000 before we know how badly that ended. I'm not saying it's a good goal to get to, but you are now seeing money flowing into U.S. stock funds and ETFs at levels from the late 90s. Individual investors have been largely not adding money to the U.S. stock market for many, many years. This goes back to 08. It goes back before 08. They got scared out from two twin 50% crashes in the S&P over a 15-year span. So Now you're seeing money not going into foreign funds. It's actually coming out of bond funds and going into stock funds, because related to all this is people think rates are going up. We're seeing money come out of muni bond funds because now you see the twin problems of rates going up and tax benefits aren't really going to be there. It's going to lower the after-tax return. So there's a lot of shifting going on by investment advisors like myself and individual investors to the U.S. stock market, which is getting expensive. So ultimately, yes, you want fundamentals or it will end badly like 2000.
It is, Nicole, almost a point where we're having more day-to-day conversations about the stock market. I don't think we're anywhere close to where we were years and years ago, where people would stop you on the street. Hey, how'd the Dow do today? I don't sense that is necessarily happening as much. A little bit, but what's your take on this run-up to 20,000? We've been killing it, of course.
I mean, maybe because people know that I'm from here, but everywhere I go, I still hear people talking about the market that we're seeing because we're breaking new levels that we haven't seen. Today we saw the NASDAQ, for example, at 5,500. Never saw that before.
Right.
We are hovering around this 20,000 mark that everybody's excited about. I mean, people are doing rain dance. Just the watch pot never boils. I mean, I saw a guy doing almost a rain dance trying to get to that 20,000. Another guy was getting razzed.
Oh, you just want to get it over with at this point.
Another guy
was
wearing a Dow 20,000 hat, and all the other guys were shouting at him, take it off. We're never going to get there if you have the hat on.
Right.
But can I add one point, which is that in Barron's over the weekend, the contrarian side. A couple of things that will maybe stop the rally a little bit. Higher spiking mortgage rates. Gasoline prices that are up over 50 cents.
Right.
And the U.S. dollar really still around these 14-year highs. So, I mean, there are reasons why you could say those are okay, but those are things that are on people's minds as well.
I've heard a lot of people, Michael, talk about the rise in currency, so that we have a currency that goes up. It makes our items that we sell more expensive overseas. There's a look at the dollar versus the euro and the other major currencies today. To what extent is all of that priced in, that people are looking at the amount of money huge multinational corporations based here in the United States can make in this environment, or are we just discounting it and ignoring it, do you think?
Oh, I don't think it's priced in, because it's a double-sided coin. A strong dollar is not necessarily a bad thing for stocks. It's a good thing for consumer discretionary stocks because there's more purchasing power for U.S. consumers. So that's one example. Now,
right.
The flip side of that is industrials, metals. They're going to suffer if this dollar is strong. If you're a U.S. exporter of industrial goods and you're trying to compete with South Korea, Japan, China, the rest of the world, you're going to be less competitive. These industrial stocks have run way ahead of themselves, and that's a problem. So this all balances out. I mean, the other point to that, though, is I will say we can talk about how expensive stocks are. We've had a nice run. 2 weeks ago, right before the Fed, stocks were looking a bit overbought. Technically, if you look at the charts and the action, right now everything's settled down where I can't look at stocks and I can't look at the market overall and say, this is overbought. It's basing it, it's settling in. In the short term, it's very positive for this inevitable run to that number whose name I dare not mention. So
right. It's like the pitcher with the no-hitter.